G'day and welcome to a Motley Fool YouTube live. Thank you for joining me. This was scheduled, I think if you read my email, scheduled for a week ago, and I got busy. So I put it out to this week, not having any sense of course, what we would find next. We knew the so-called Liberation Day, I'll say so-called a few times today, was going to happen. And so that's kind of, I guess that was known. But we kind of wanted to have this original chat just to kind of give our readers, members, viewers a chance to come and be part of a conversation. In the preceding week, or the following week, I should say, we've seen a bit happen. And so, as I joked in my email only a little bit earlier, this started off as a market update, then it was tariffs and market update. Now it's tariffs, market slump, and market update. And that's where we find ourselves. So thank you for joining me. I dare say we've got a few more people after yesterday's or last night's fall in the US markets and today's fall on the ASX than we otherwise might have had. But I hope your time will be well spent over the next hour or so. I promised the team I'd get out at 1:30 local time. It's now 12:31. So 59 minutes of power, hopefully. TC's already got a question. Good man. Good lady. Don't know who TC is. Thank you for tuning in. Right, so let's do the lay of the land first, and then I'll get to some questions. I've been pretty forthright on my view on policy, regardless of the party, regardless of the country, regardless of who it offends, because not because I'm trying to offend people, but because I figure that I work for our members. That's literally, other than a tiny bit of advertising, the only money we get is from our members. So my job is to give it to them straight. Not always the stuff you want to hear necessarily if you are a member. So apologies if I've ruffled some feathers, but I don't care about politics, at least not the political partisanship and the political affiliations. My job is hopefully to call it as I see it. I don't want to always be right, but I'll tell you exactly what I think. You get the full unvarnished version, and you get the version that's not been tainted or sanded down or rounded off or whatever by some other interest. We only have one interest at the Motley Fool, and that is to serve our members. And more broadly, our readers and viewers, of course. If you're not yet a member, that's okay. This is live and free. There is no sell at the end of this one. I'm not going to tell you anything. I'm not going to ask you to buy anything. This is just because we're trying to do the right thing. Now, yes, we get some benefit if, some people like what I say and think, gee, I might sign up with that guy. So, yeah, it's not entirely altruistic, but it's pretty close, right? This is just about trying to do the right thing for our readers, members, and viewers, and that's why we're here doing this. I hope to do a few more of them, by the way. Hey, we'll do a quick plug, not selling anything at all still, by the way. I'm pretty sure ads aren't turned on YouTube, so I don't think we get anything from this at all. But what I will tell you is that we are doing a whole lot more YouTube videos. We did some a few years ago, and we kind of, resources got tight, and we kind of directed ourselves in different directions. We're starting it again. So on Wednesday just gone, our first one for ages, Stocks in Focus, is now out. We did it on Drone Shield. Andrew Leggett joined me for that, which was awesome. We're releasing our Stock of the Month, an actual Motley Fool recommendation later today on this channel, live, not live, but premieres live, but goes live at 4:30 p.m. Eastern time, and is also completely free. So no obligation, no strings, no nothing. And we're doing a semi-regular series on just what we're reading. Books, articles, stuff we find interesting that if you're kind of into investing in business and finance, we think you might like too. That comes out on Saturdays about lunchtime. So I'm sorry, that was an impromptu plug. I still don't make anything from it. It's not going to cost you anything to be part of. Sorry, I got the sniffles today. But yeah, please do come along and have a look. If you subscribe to the channel, so under me right now, I can see is there a subscribe button? There must be somewhere. Yeah, jump on the subscribe button and then hit the notification bell as soon as it comes after doing other videos we do. As I said, I'm going to do more of these. That's where I started. I'm going to do more of these in the coming months. Hopefully, I don't know how regularly, maybe once a month or so. Let me know how frequently you want this. I know you don't want to be here every Friday listening to me bang on, but some sort of cadence might be useful if you're enjoying these conversations, if you want your questions answered, if you want to hear what's going on. That's what we'll try and do. So there was a really big, I gave you a really big setup about telling the truth, telling honestly, being straightforward. Here's the thing. Tariffs are woeful policy. And by the way, so are subsidies. So whether you're talking about the right-wing Republican tariffs or the left-wing Australian subsidies, they are both terrible economic policies. Why? Because they basically don't let the money flow where it naturally would flow. You're putting artificial barriers in place. Both those things, by the way, cost more money. Either they cost consumers more money when it comes to tariffs or taxpayers more money when it comes to subsidies. Now, are there some cases? I suppose, yes. If there's startup subsidies required to get something up and running, you can make an argument that it helps an industry start. Maybe, possibly. Are there defenses of tariffs? Only one that I can really genuinely think of from a policy perspective. Again, I don't care if it's a Republican tariff or a Democrat tariff, I don't care. Joe Biden put tariffs on Tesla or Chinese cars last year. Equally indefensible, right? This is not me saying I do or don't like this person or that party or this side of politics. I genuinely don't care. Haven't even decided how I'm going to vote this year yet, so we'll see how that goes. So tariffs are bad, with one exception. That is if there's genuine dumping. If someone's going to dump a whole lot of stuff for a limited time, let's pick on the Kiwis, right? Because they're lovely people. They're not going to do it. If the Kiwis are going to dump a whole lot of wool in Australia, and all of a sudden we're like, oh, hang on, they're dumping it under cost, and they're doing it just to try and mess up our markets. And yeah, in that case, if it's going to distort a market meaningfully, then yeah, that's called dumping. And yes, we probably should do something about it. But in those really, really rare exceptions on both sides, tariffs are dumb, subsidies are dumb. They distort markets. They mean that competition doesn't work. They mean capital doesn't flow to the best possible uses. People don't either. They hurt our standard of living because it costs us more to buy stuff. We have to spend more in taxes to pay for the subsidies. It's just bad, bad, bad policy, right? I'm not a fan of unfettered free markets. That might be a surprise to some people. I'm a fan of capitalism. I'm a fan of well-regulated capitalism. That means letting the market decide, but having some guardrails around the edges, right? Pollution, probably bad. Child labour laws, probably important. Pick your preference, right? Make sure competition works in the first place, really important. Make sure there's no cartel behaviour, really important. So, not a fan of absolutely free markets. I am a fan of lower C capitalism, not the crony capitalism, not the distorted stuff that we sometimes see. Don't tar me with this brush. I was accused of being a friend of the billionaires because I said I like capitalism the other day on Twitter. No. Why? Because it creates value. Capitalism creates value. I hope if you're watching this, you're probably an investor, you get that, right? But if you aren't an investor or you're just getting into it, you just want to know what's going on, capitalism is just describes the system of me swapping my labor for my boss's money, and then me swapping that money for something else I want, and that other person providing something I want because I want it. And around we go. What we end up with is a higher standard of living because I get what I want. I get paid for my time. Again, with regulations, not perfect. Don't at me, as the cool kids say, but it works. And as Winston Churchill about democracy, I make it democratic capitalism. It's the worst system except for every other system that's been tried, right? So in other words, for all its faults, it is still the best option, still the best way to allocate scarce resources. That's what it's about. So that's a long wind up. And it is important, right? Because it does talk to what is happening in the economy right now. It talks to what might happen next. And of course, then it talks to how countries like Australia or other countries around the world might retaliate to these tariffs. Thank you for lots of people throwing their questions in. I will get to absolutely some of this stuff for sure. Yes, I will do all that stuff. Okay. But I'll keep going for now, and I will come back to your questions. So thank you. I don't think there's anything I need to answer. I've done everything in as much detail as I can, I think. Okay. So here's the thing. Why don't I like tariffs? Let's get back to it because it matters not just ideologically, but practically for the rest of the world. And I promise I'll get off this stuff and on the economic circumstances in time. But it's important to set this up, right? Because the so what matters both for policy and for implication. When you put a tariff on something, we all hopefully know that by now. Donald Trump tried to say for a while it was a tariff on China and China was paying the tariff. It's absolute nonsense. We know that, right? I hope you know that. If you don't, let me explain. When you put a tariff on an import, let's say an import to Australia, let's say it was bourbon whiskey for the fun of it, because let's pick on the Yanks. Your bottle of Jim Beam goes from $40 to $45. Why? Because it's this is a bad example, $44. Let's make it easier. There's a 10% tariff on bourbon, right? And so I will stop. Someone will tell me that it doesn't include the retailer's margin. That's true. It's not 10% on the final price, it's 10% on the cost price. So it costs the retailer 10% more to buy Jim Beam from the Jim Beam maker. So I'll put that out there just to be really clear, but I'll stick with my numbers because it's easy. Jim Beam goes from $40 to $44. Now it's a tariff on US products, yes, but it's a tariff on US products when they're bought by Australians. So what happens? We pay more for Jim Beam. We pay more for Coca-Cola. We pay more for Levi's. Pick your preferred, iconic US brand. We pay more for that. So what does that do? Well, it means that if we either don't buy it, so we miss out on what we want. That impacts our standard of living. Our so-called utilities, economists say. We want some things. I can't buy that thing anymore. I choose not to buy that thing anymore because it's too expensive. My utility, the benefit I get from all of my spending goes down. Or I pay more for that bourbon. And so that $4 extra I spend, I can't spend on a pack of chewing gum or a bottle of Coke or whatever you want to go. Probably Coke with bourbon. Let's go with that. I can't buy the bottle of Coke because I spend my money on bourbon. Now, I can take $4 from somewhere else, but again, that money can't be spent. We're not all getting 10% more income just because tariffs go up 10%, so we can buy 10% less stuff. Right? That's the key fact. So our standard of living drops. Now, maybe you say, well, it helps locals. Yeah, the $44 bottle of Australian bourbon, it's not Australian bourbon, I think Australian whiskey, that I might have otherwise bought Jim Beam because it was cheaper. Now I'm buying the Australian stuff, that's fine, at $44, but I'm still spending $44. I'm still worse off. I don't get the product I want, And I've spent more money than I was going to quench my proverbial thirst, maybe over on a Friday night. Maybe tonight, we'll see. But that's, I don't drink bourbon, by the way. Not only just because the Americans are being mean to us, but it's not my tipple of choice. So that's where we start, right? That's why tariffs bad. It increases prices in America. Now, when you increase prices, firstly, inflation goes up. Now, by the way, these aren't predictions. These are directional impacts of this stuff. So prices go up. So inflation goes up, right? That's the first thing. Second thing, if I'm spending $4 more on my bottle of bourbon, I'm not buying $4 worth of flowers from the flower vendor. And so that Australian flower vendor doesn't have my business. And eventually, at some point, doesn't have enough business for everybody else. And either he goes broke or she goes broke, or he or she lays off one of the workers. So what happens? Either businesses fail or jobs are lost. So now you've got less more inflation plus fewer jobs. And by the way, if that goes through the cycle, the person who gets laid off doesn't spend their money in the economy. What happens then? Well, GDP falls. The Atlanta branch of the US Federal Reserve is predicting recession on the back of these tariffs, or tariffs in general. Actually, they did it before these were even announced. And by the way, when I say 10%, it's 10% Australian stuff. Us, the Poms and a couple of others have 10% tariffs. We are treated less worse than the rest of them. Some are 40, 49% tariffs. It's extraordinary. The impost on the American consumer. Now, people say, well, it's America first and Trump's doing it for America. If he is, he's doing it really, really badly. Because here's the thing. People say, well, it'll create jobs in America. Those tariffs will set up the sport industries. They'll create jobs. Here's the problem. How long does it take to create a new steel mill? Because there's a tariff on steel and aluminum out of Australia. A very long time. By the way, some of that tariff is on steel products out of Australia that no one else makes in the US. So there is no substitute. There is no alternative. And if some jobs are created in the US, their unemployment rate's about the same as ours. Now, maybe 0.5% of those people have the skills and attributes required to staff the startup operations that tariffs are making possible. Maybe, if you're really generous. So for 0.5% unemployment increase, you increase prices across the economy, maybe increase unemployment, which, by the way, causes its own problems, and potentially creates a recession. So are the goals worthy? Of course they are. Would I like an Australian Prime Minister to say we will have the lowest unemployment possible in Australia? Of course I would. Would I like the Australian Prime Minister to say we should buy Australian and support local farms, local jobs, local businesses? Absolutely. Should we put tariffs in place to do it? No, that's a terrible idea for all the reasons I've just explained. Now, there will be some people watching, I don't know if they're in the comments yet, we'll see, who are saying, but Donald Trump said this, or Donald Trump's doing that, or he's playing 4D chess or whatever. Maybe. Here's the thing, we've been here before. This isn't just economists. And so, by the way, every credible economist thinks this is a bad idea. It's not just me spouting off. It's not just the so-called left or the so-called center or the so-called whatever, the anti-Trumps. As I said, if Australia did it, I would say it's bad. The Chinese have done it to Australian wine. That was bad, okay? This is not me bagging the Americans or Trump or anybody else. Happily bag the Chinese. I'll happily bag anyone who puts tariffs on Australian products. Bad for us, bad for them. Just bad all round. It doesn't solve any problems. It masks them over under some political rhetoric of America first or whatever you want to go with. So I hope I've been reasonably clear there. If I haven't been clear, I'm not sure. Please feel free to jump out and ask me the question. I can clarify if you need to. But that's the short version of the detail. Now, there are some people who claim he's playing 4D chess and somehow he's got some other whatever. And I don't know, maybe he doesn't strike me as the sort of guy who plays 4D chess. And that's kind of a bit direct, but it's honest. For a bloke who's shown zero policy interest in his first term of any meaningful change, maybe there's Damascene conversion happening, but maybe there's not. So decide for yourself. But it's just bad policy. And by the way, I'll tell you a history. There were tariffs introduced during the Great Depression to try and fix things. They made things meaningfully worse. They're called the Smoot-Hawley tariffs. There's great articles, great podcasts. There's a great NPR Planet Money podcast on the Smoot-Hawley tariffs. If you want to look it up, go and have a look, have a listen. You'll get the detail. We've known for years tariffs are bad. They're bad for trade. They're bad for standard of living. Reducing tariffs means we're all better off. It just does, right? And trade is good. We trade Australian wheat and Australian beef, and in return we get manufactured goods from overseas where they make them cheaper than us. Now we could keep all our wheat and I guess at some point just grind it into the ground because we had no markets for it, and we could try and make our own iPhones or computers or televisions or whatever you want, cars, whatever. Here we could try. We couldn't do it cost effectively. No one wanted. That's why they were subsidised here. That was bad. Australian car policy was bad. Subsidies are bad. So you get the idea, right? History shows it. We know what's happened by putting them on, by taking them off. It's just bad policy. It's a bit of a rose-colored glasses nostalgia. Oh, if only we could go back to this thing, everything would be okay. Here's the other thing: the jobs that people want to replace or reintroduce manufacturing jobs. They're good jobs, but they're low-wage jobs. We'd be taking people out of productive, profitable, higher-wage jobs and putting them into jobs in companies where that was lower wage. The companies couldn't survive on their own 2 feet. The taxpayer had to tip in to make it work. As a country, that would dumb us down. It would make our productive capacity worse. We'd have a lower standard of living. That's enough on that. What do we got? I'll come back to the questions still. Okay, so what's happened this week is we saw yesterday here our market fell. Overnight, the US market fell precipitously. I don't want to overstate it. I mean, 5% is only 5%, but it's 5%, $2.7 trillion apparently. Whatever. I don't care about volatility. I know a lot of people watching do, and I don't mean to sound flippant about it. But I will talk to that in a second. What I want to say is it was impactful. And often the stock market and the economy are always two separate things, right? We should never believe the economy is the market is the economy. It's just not true. It's absolutely not true. But there's also some very clear causality between tariffs introduced or announced and markets falling. What happened? Well, at the end of the day, the traders and investors on Wall Street went, if this happens, and I've just been through all the circumstances, we're concerned that the result of this, because the traders and investors think it, the economists think it, the foreign trade experts think it, we think America will be less prosperous for a little while at least as a result. And if that is true and American companies make less money, then share prices will fall. Also, by the way, I've said this before, I haven't updated the number in ages, but probably 4 or 5 years ago, the S&P 500, I think it was 52% of the revenue for S&P 500 companies. Now, for those who don't know, the S&P 500 is the most prominent index of American stocks. The top 500-ish of the US companies, we kind of grab them together and then track how their prices move. That's the S&P 500 index. When you see that quoted, that's what they're quoting. About half, give or take, of the revenue for the S&P 500 comes from sales those companies make overseas. By the same token, a lot of products sold in America come from overseas, either as finished goods or as raw materials. And so not only are we seeing potentially the US economy struggle, we're also seeing the potential for US companies who are there to have their input costs increased, as well as have their sales revenue potentially dented. Now, they are protected by that half outside the US, as I said. The problem is a lot of their inputs come from outside the US, so there's no free lunch here. Well, there is a free lunch. It's called trade. It's called comparative advantage. It's called no tariffs and subsidies. But that's where we start. So that's why the share prices fell in the US. Why are they falling here? Two things. Three things actually. The tariffs will impact Australian companies directly. 25% on steel and aluminium, 10% on everything. That's the direct impact, right? Any products going to the US, and by the way, agriculture, poor bloody farmers getting whacked again. 10% more for Australian beef going to the US. Everything going to the US now 10% more expensive. Quick aside, by the way, they claimed that Australia had a 10% tariff on the US. We absolutely don't. By all reports, they confused our GST with a tariff. Make of that what you will. Yes, I'm a little bit critical. I don't apologize for that. I think it's dumb. But again, not because it's individuals or parties, just because the policy is dumb. Second order impact. We send a lot of stuff to China. China sends a lot of stuff to the US. When that gets more expensive, Chinese exports fall, and potentially the Chinese economy is weaker. That's possibly bad news for Australian companies doing business with China. And again, we think about our miners most predominantly, but anyone in general. And by the way, it's not just China. If we send stuff to, I don't know, I don't have the other tariffs off the top of my head, Bangladesh, and they send stuff to the US. These are global trade is global. It's in the name. And so that's potentially a risk. And thirdly, on a share market basis alone, two kind of conjoined things. First is when the US is in financial trouble, US investors tend to bring money back to their home market. What does that mean? Possibly selling of Australia, potentially shares, potentially currency, other assets, because they want to bring their money back to the US. It's just what investors tend to do when things get tough. They kind of go, oh, we'll bring it back home just so we've got it. So that could happen. The other thing, though, is we know that, frankly, capital is global. And so when the US market falls, we tend to fall here. The other bit on that global bit is chance of recession. If the US does go into a recession, there's an old cliche, when the US sneezes, Australia catches a cold. Is it guaranteed? No. Does it make it harder for us to grow when they're going backwards? If they go backwards, yes. So that's what US markets are worried about. That's what global markets then, as a result, and directly, are worried about from their own perspectives. And that's why we've seen big falls. Now, I said I'd go back to the bigger picture. I wrote yesterday, I hope you had a chance to read it. If you didn't, it's on the full website. You can find it. Here's my guiding principle, right? Whenever the market falls, markets, the Australian market, the US market, not every market everywhere for everything, Australian US stock markets, let's be really clear, have never failed to regain and then surpass a previous high. In other words, we've fallen a bit, right? We've never failed to go back to that level and above in the fullness of time. Now, I don't know how long it'll take. It might take, I said this during COVID, by the way, and we had the fastest recovery in history. I said it through lots of other, we've had corrections all the time. Markets fall all the time. If people say, oh, maybe this is the big one, maybe I should get out. The market has never yet failed to regain, then surpass a previous high. Why? Because human ingenuity, resourcefulness, and capitalism has never failed to find new solutions to new and old needs and wants. In other words, the iPhone happens. The internet happens. AI happens. There will be continued growth. There will be innovation. There'll be better solutions, cheaper solutions, high quality solutions. Someone's going to build a better mousetrap. And if it's better, we're going to buy it. And if we buy it, that company's going to make money. Over time, productivity works. Now, not recently in Australia, that's a whole other can of worms. I'm not going to go into that today. But over time, we become more productive. We find better, easier, faster, more efficient, more accurate ways of doing things. Technology is a huge part of that. Technology is the largest driver of that. So productivity is not just, and you hear some in the political sphere try and smear each other with this stuff. Productivity is not making a worker work 50 hours instead of 40. I mean, some bosses might like that, but they can get stuffed. Productivity is usually my 40 hours and technology. 40 hours plus the internet, 40 hours plus the fax machine, 40 hours plus email, 40 hours plus pod, plus YouTube. This is free going out to everybody who wants to watch it, right? Now, does it make me more productive? I don't know. It depends if you join up or not, I suppose. But you get my drift, right? AI. We don't use AI much at the Fool at the moment. We do use it in the back end a lot. We haven't done it for our front end stuff because we're still trying to work out how people are going to respond to it and how we have our bit versus AI bit. Anyway, that's the direction the world's going to head, right? It'll make us more efficient, it's going to get better. And so new solutions to new and old problems, wants and needs, that's what capitalism does. If you think we've reached peak capitalism, if we never get any better at all, I guess sell your shares and buy baked beans and a shotgun and go and find a cave. If we do keep getting better, then this little dip, I mean, I haven't got it ready. I should have had the Vanguard index chart ready. I don't know if I can do it on a live stream. Maybe I can, maybe I can't. Google Vanguard index chart, not now, later. And you'll see over time, you see this massive just up and to the right story. And yes, you see the COVID dip. Yes, you see the GFC. Yes, you see the dot-com boom over the last 30 years. And yet the market is 13 times higher than it was on 30 June 2024 than 1st of July 1994. 13-fold increase. Did we have stuff happen during that period of time? You bet we did. We had COVID, the GFC, the dot-com crash. We had second Iraq war. We had terrorism in the US and Bali. We had the Asian financial crisis in 97. No one even remembers that anymore. Y2K. I don't know, pick whatever else happened, right? It happens. It always happens. It's always going to happen. So the market rose 13-fold despite, not in the absence of, real problems and 25 times that many headlines of screaming disaster. China was going to run out of foreign currencies. Anyone remember that one? The Chinese property bubble was going to pop and we're all going to, be destroyed. Does anyone remember that one? Even Credit Suisse went broke and the contagion was limited. Silicon Valley Bank, similarly. Now, I'm not saying those things couldn't have been bad. Some of them were. I'll put my hand up. I got COVID wrong. Very, very early in COVID, January 2020. I thought, well, it's probably going to be like SARS and MERS before. Remember those ones? Because we'd seen that story before. And I'm probably the same. I was wrong. It was a big deal. It was a massive global pandemic. And yet, the market fell 38% in a month and 4 days between the middle of February, the end of March, or early April, and then recovered and went higher and higher and higher again. It's what happens. So yes, I'm all in. Now, am I saying this because I work for the Motley Fool? No. I'm getting the opportunity to say it because I work for the Motley Fool, but I joined the Fool because I believe in the power of capitalism and investing. Literally, I took a pay cut from my previous job. I'm not a martyr. I'm not asking for thanks or praise or congratulations or whatever the other is. Maybe you want to sympathize with me. I did it because I believed in what Motley Fool was doing as a business, but also I believed in the power of investing. So, this paycheck is good. I like it. But my portfolio, I'm not going to risk my entire portfolio to toe a company line. And by the way, I own nothing other than my home, a couple of used cars, and a share portfolio. And a phone and bits and pieces. You know what I mean? There's no investments. I own my principal place of residence and shares. Some cash on the way through to being invested, but effectively that's it. So I'm eating my own cooking. I'm not telling you to do it and then going off and buying investment properties or buying gold or something else. I'm saying I think this works for the long term. That's why I do it. That's why I want you to do it, because nothing worse than the convert, right? So I'm like, oh, I found this thing. I'm going to tell you all about it. I can't help myself. I'm telling everyone about it. That's why I'm here. That's why I'm still investing. So even though the last week has been scary, and for all I know, the market could fall 5% next week or rise 5% next week. I don't know. No one knows. Please don't listen to anyone who says they know. And please be really careful with market timing. There are some really smart, wealthy, well-connected people who during COVID, in that first month, went, I'm out. I'm not coming back until the COVID pandemic is over. Well, guess what? That was 2 years maybe after that fall. And the market had recovered almost everything on the way through. They'd sold out after it hit and they missed the recovery. And that was really, really, really consequential for their returns and their portfolios. So now, I'm not saying any company's going to do well. I'm not saying any company's going to do fantastically well. Another time we'll talk about diversification and other basic investment principles. Today is not that day because of where we are and what we're doing. But what I will say is a quality, diversified portfolio, Australian, and half of my portfolio is in the US. I got whacked last night. Do I care? Yeah, it hurts. Am I worried? No, I'm really not, because I've got a diversified portfolio of quality businesses that I think will be bigger and better in 5 and 10 years' time than they are today. And that's why I remain invested. I don't know what happens next. God, the rest of Trump's term's a long time. Anything could happen or nothing. This could be as bad as it gets. That's the point, right? People say, oh, I'll sell out now and buy back in when what? No one rings a bell at the bottom. Maybe you sell out now and the market goes up tomorrow and you go, oh, I missed out. Maybe it falls another 10%. I don't know. And I will say I don't care. I care because my portfolio gets lower. I care because our members worry. And if you're watching this, you're a member or you're not a member, you're worried. That's why you're here. And I appreciate you being here. Thank you. But I'm not going to take that approach of saying I'm going to try and time the market. Why? Because it can't be done. But here's the other thing. David Gardner, the Motley Fool's co-founder, you've probably heard this story before. I love it. When he's asked, so when someone asks me what the markets do, I say, I don't know. I get to say I don't know. No one else does. No chief economist anyway gets to say, I don't know. They have to have a forecast. And whether that's because of their own hubris or their job requirements, you can decide. I just say, I don't know. And it drives my interviewers nuts because they just want something, right? David Gardner has a different approach. When he's asked what the market's going to do next year, he says it'll go up. Now, not because he knows it's going to go up, but because historically, the market's gone up 2 years out of 3. So he reckons he's going to be right 66% of the time if he says it'll go up, and that's better than most people's strike rate. And he's probably right. But either way, the market does tend to go up over time. I just told you, 10 to 13-fold, 10 grand to 130 grand over 30 years, the last 30 years, according to Vanguard. Now, do you want to bet against that? Do you want to try and time the ins and outs of that and try and somehow do even better? If you want to, I don't blame you. But really, I want to talk about you. Do I have the skill, the insight, the crystal ball, the luck, the whatever, to get it right enough to not just take advantage of the long-term returns just because they happen? Who's going to look a 13-fold return in the mouth and say, no, I'll gamble it, thanks. I'll see if I can do even better by market timing. I think you can do better by stock picking, by the way. But market timing, who knows what's going to happen next? The COVID thing. The market recovered even as COVID got worse. The pandemic started overseas, nothing in Australia. Little in the US, it was all in Asia. Maybe it's going to go international. Who knows? The market falls. And then it gets worse. People die, unfortunately. It's horrible. People have been injured. People were sick. Economies were locked down. GDP fell. And what happened? The market recovered. Why? Because people looked forward and said, when this finishes, company X, stock market Y, will be worth as much or more as it was a year ago. So what are we freaking out about a short-term problem? And that's the key point here. I think the policy is terrible. I think it's destructive. I think it's bad for America. It's bad for us. Tariffs are stupid, right? Can I be clear? I think I've been clear. Can I call a spade a bloody shovel, as I said yesterday? I think I can. So I've done that. But is it going to stop me investing? Absolutely not. Because as much as it might be bad, it may even bring a US recession. And would that be bad for US company profits? Yes. But what if it doesn't bring a recession? What if I'm wrong? What if the impact is mute? What if some win and some lose? What if share prices don't go up anyway because the market's looking forward and saying, well, okay, but at the end of that, we're okay. Looking at the economy, I said at the very beginning, the economy is not the stock market. Stock market is not the economy. In fact, the economy tends to lag the stock market. The stock market sees a recovery coming and starts buying. I don't know when that'll happen. I really don't. But trying to time the market, trying to guess the time to get out, then the time to get in, and getting both those right regularly. There's very, very few people found who can do it reliably, regularly, and repeatedly. Right? So, what am I looking for? Don't know. The word that means you can do it because they've done it. You can't teach someone to do it that way. I've lost the word. That's why I don't try and time the market. Now, people want to believe they can. Why? Because we're just we're built on ego, our human emotions. I can do this. I'll give it a go. I'm smart. I can do it. Maybe you can, but you probably can't. And why take the risk if you can get from 10 to 130 grand in 30 years? It doesn't make any sense to me. That's exactly half an hour. So I'm going to get into some questions. Got a heap. So thank you so much for everybody who's thrown the questions in. Let's start with TC. Is this an opportune time to be selling lower quality businesses or if it's higher quality has become better value? That is the perennial question, mate. And here's the thing about the COVID crash. We actually saw the market fall and recover. Which fell harder? The low quality businesses. Which recovered more? The low quality businesses. So it's kind of one of those problems. When the market falls, the best value is usually not the highest quality companies. So it depends on your risk appetite, depends on your portfolio construction, depends on diversification. Oh, one thing, before I even finish this question, I'm supposed to say at the very beginning, we can't give personal advice at the Motley Fool. I can't tell TC what TC should do. I give you general advice, general thoughts, general observations. I tell you which companies I like and don't like, what industries I like and don't like. I tell you all that stuff. I can't tell you what you personally should do. So please, it's really the point, right? Please don't take anything I say as personal advice. Please either consider how it meets your personal needs or go and speak to a licensed financial planner or advisor to get if you need it from somebody else. So that's the key. TC, I don't know, mate. I wish I did. It'd be an easy question to answer. I think you want to, if there's quality companies you really like, particularly when you go hold for the really long term, that you think compound for ages, I love buying those when they're cheap because it's just like, hey, the risk of the company is much lower and I get a better price, so I should go for it. That being said, I think it's almost, I was going to say almost certain I shouldn't, very, very, very likely that when you're at the bottom of the COVID, if you look at the recovery from COVID, the ones that did better were the lower quality businesses because they were the ones that were more likely to go broke if things got worse. So they were sold off harder. So the harder something sold off, the more chance got to rebound, generally speaking. So if I'm saying what's going to have the biggest upside over 12 or 24 months after a big crash, it's probably most often the worst quality companies. But also, if that crash had gone longer, they may go broke. We've seen plenty of bad quality companies go broke on the ASX and elsewhere over the last little while. So the best returns are probably from the riskiest businesses. But do I want to play that game? Me personally, no. So I don't mind your approach. I'd be very happy to do something like that. If I got some of my favorite businesses cheap, I happily do it. The other side is you very rarely get those quality businesses cheap because the rest of the market knows that as well, which is why it sells off the low quality stuff. But if you want to do that, I think that would be a very worthwhile exercise. Just know you're not going to jag the best returns from here because it's going to be those death or glory companies. Some go death, some go glory. And so individually, there'll be better companies. As a portfolio approach, not a bad idea. Latent SBF, no, you don't forecast, but so that's what some of my interviewers do on radio these days. I don't forecast, but what do you think is going to happen? Thoughts about the dollar? Oh dear, no, because again, like I said about the markets, I don't know how long it lasts and what other traders are already thinking. Maybe they've already priced it in which case it goes up from here. Maybe they haven't, it goes down from here. It's impossible to know, mate, because you've got to know what people are thinking, how sentiment changes. The facts should be that in theory, the US dollar should weaken against other currencies. That's what should happen in these sorts of circumstances. However, has it already done that by enough now that the information is known? Maybe. Does sentiment get worse? Maybe. Does it get better? Does hope prevail? Maybe. So I know I'm not trying to duck the question. I'm trying to answer it as honestly as I can. I don't know because you've got the two layers. You've always got the theoretically what should happen, but also because that theory is known, what if traders and investors try to get ahead of and speculate happening? And so you're kind of guessing what they're guessing. And that's when it gets really murky. It's why I don't try and time the market for exactly those same reasons. So apologies for not giving you a straight answer, not giving you a yes or no answer. I don't know because you've got to try and overlay those two things and guessing what the market thinks and then what the market might think. Oh, it's pessimistic now. Maybe it'll get better. It's pessimistic now. Maybe it gets worse. I don't know if you're going to be a very good judge, not of human behavior, but of a very specific subset of humans, their behavior and their expectations and what they might do next. Panic tends to be pretty serious, but recovery comes pretty quickly. The COVID crash, have a look at the share price. It's literally a V. The market goes down, then almost straight back up. It's not quite, but it's almost a tick maybe, rather the big fall and the longer recovery. But at any point in there, who knew what was going to happen and how and why and when? I didn't predict it was going to be the fastest recovery from a bear market in history. I had no idea, but that's what ended up happening. So trying to time it is tough. On the flip side, by the way, the GFC lasted 16 grueling, drawn-out, grinding months, and the COVID crash was a month. So it's, I don't know. I wish I did, but if I did, I'd happily trade it if I knew. I guess that's the better way to answer it. I'm not trying to trade it because I don't know with enough confidence which way things will move. Is it a good time to buy banks now? I don't love the banks at the current valuations, I have to say. It's always a better time to buy any company when the shares are cheaper than they were, because unless you lose 100%, the downside's less than it was at higher prices. I know that sounds like a silly, flippant answer. I don't love the banks because I think they're overvalued. I think the growth that's implied in their share prices is not what they're delivering as businesses and not what they're likely to deliver as businesses. So I wouldn't buy the banks personally. Macquarie, sorry, I should say the big four banks. I do like Macquarie, but that's not a timing thing. That's just smart people making smart decisions to make themselves money and making shareholders money in the process. That's a pretty good, aligned incentive. But the big four, even the little regionals, don't know any of them are cheap enough to buy, other than for income. If you're building an income portfolio, you might throw a bank or two in there, but a small percentage, not the. So many people have got 40, 50, 60% of their portfolio in the banks. That's crazy behavior. So I wouldn't buy the banks now. So apologies, Grow. I can't say yes on that one. Treasury. Wine Estates, TWE. Whoa, I will very lightly scold you. At the Motley Fool, I make all of our teams about company names, not tickers. Why? Not that it matters. We all know what we're talking about, because it's indicative of the way we think about companies. So we don't think about tickers, we think about businesses or companies, right? So I make the team. Don't tell me TWE, tell me Treasury Wine Estates. I mean, same acronym, I suppose. I own shares in Corporate Travel Management. Everyone knows that probably by now. CTD is the code. I joke that people get a formal employment warning if they use the code rather than the company name, or at least CTM, the company's abbreviation, not the stock code. Just a bit of levity, but with a hopefully a significant underlying rationale there. It's just we want to be careful about not starting to think about things as three-letter codes that I trade, but rather businesses that do a real thing. Treasury. It's a good question. I suspect that Treasury is not as impacted as the share price might. I own shares, I should say. Sorry, I should disclose that. My apologies. The only tariffs here are from international products going to the US. Now, that impacts absolutely some of the Penfolds products going to the US. And so as a result, will it have a negative impact on Treasury sales and profits? Yes. Will it be a big impact? I doubt it. Most Penfolds goes out of Australia to the rest of the world, including the US, of course. So it's part of that. But Australia to China, Australia to other markets in Europe. But also Treasury has US-based brands, which does its own business over there. So overall, I haven't done the numbers, but the proportion of Treasury sales going to the US as a proportion of its total business, probably not meaningfully significant. And of that, the proportion that'll be reduced by, I don't know, I'm not even going to try and make up numbers because I don't want to be misleading. Whatever the proportion of their sales are, that'll be hit with a tariff, but that won't go away. It gets reduced by an amount. And I don't know how much that is. It might be 5 or 10%. So a proportion being reduced by a small portion, I suspect the share price falls overdone. Could be wrong. Retaliatory tariffs are always possible. I didn't even cover that in the opening, but if they happen, they could impact stuff. It's hard to know. I'm not worried about my Treasury shareholding. I think the bigger story is the return to growth and size of the Chinese market relative to the Australian export opportunity to China. That's where the growth was. If they get back to that, I think the future's pretty bright. It's not going to be a double bagger anytime soon, or 10 bagger anytime soon, but I suspect the growth's okay if they manage to get that bit recovered to speaking of tariff, the pre-Chinese tariff levels. I suspect that's probably, roughly where I think they'll get back to. I think they're inexpensive relative to that. Thereafter, I think it'll keep growing in China, and I think the US-based business will keep growing. At some point, maybe tariffs get reduced. Or maybe the other thing about tariffs, the impact is year on year. Next year, they'll grow from that the new base with no additional tariffs, hopefully. And at that point, they should be able to grow on a like-for-like basis more reasonably. Same with any other company, by the way. Once you absorb the tariff, unless it puts you out of business or meaningfully reduces your ability, wherever your new lower base is on the base of tariffs, you then grow from there moving forward. 20 minutes. Keep going. Tax cigarettes as much as you want, says Caroline. Quiz Queen. Love it. Okay. I'm not sure where that came out. Well, I'm not sure where that came from. But thank you. I appreciate that. A tariff is not just another tax. Could the same be said for all taxes? They are not just they aren't just another tax, but they are a very specific type of tax. And the same couldn't be said for all taxes because they are based on country of origin. And so, yes, all taxes are a reduction of demand, because if I'm paying tax, I'm not spending my money. It's absolutely true. But what it does do is it disincentivizes and makes worse the buying power of an Australian. I'll go with America. American to buy Australian products they prefer to have, not all products across the board. And so is it not just another tax? Yeah, I guess at one level. The way it's being levied, though, is actually bad for US consumers and it's bad for US companies. Why is it bad for US companies? Because it actually promotes the uncompetitive businesses. We talk about, don't want to get socialism, communism, really. Actually, I was going to say it, I'm not going to. Companies that are propped up by governments, pick your favorite one. That's where you end up with lots of those. And so you end up with bloated, inefficient businesses, standards of living are lower. So it's the same. If interest at a 10% tax to everything, would it be worse? Yes. Yes, absolutely. It would make a standard of living worse. That's absolutely true. The way it's being done is even worse than that because the tax is in place and it incentivizes inefficient, less productive, less competitive businesses, which take up a larger share of your economy. That bloat makes you worse. M. Carber, out of the loop. What's Trump's reason for protectionism? I hope I've given you that one. America first. He hates the other people. By the way, the tariffs were actually just a halving of the current trade deficit. There was no objective. They called them reciprocal tariffs. Absolute garbage. Wasn't. Again, I'm not being political. It was just straight out garbage. It's wrong, ridiculous, silly, incorrect. They weren't reciprocal. They were calculated stupidly. It's to give other countries a bloody nose so we can say America first. Is my personal view. If there's any economic benefit to it, I'd like to see it. I haven't seen it yet. Why is technology hit so hard on our market? Wouldn't think tariffs hit them significantly. You're right, Sharif. It's when America sneezes, Australia catches the cold. The US tech companies are down further, so ours are as well. It depends on the company. It depends whether they're doing business with the US. It depends where the business is going. Satire is an Australian company that's had to make some meaningful changes. Australian listed company had to make meaningful changes to their business. I don't think it should have impacted ours. Capital is global. I kind of mentioned that. You probably posted the question before I mentioned it, but I mentioned earlier. When the US market falls, ours tends to fall, kind of because the Americans take capital home and kind of because everyone just gets frightened. And that's, by the way, why I'm saying just be careful about taking too much to heart. The volatility is sometimes just sentiment. If it is genuine value reduction, that's interesting. If it's only for a year, not as interesting. And if it's only just sentiment, like I'm scared, that's actually great because that's an opportunity for us to buy. If there's no fundamental reduction of value, then it's just a reduction of price. That's great because then price falls below value. Their upside, that's what you're looking for, right, as an investor. So you're right to think about that. Be mindful of which relationships those companies have with other companies or where they're sending their products to or selling their products to. But broadly speaking, yeah, company by company, but they shouldn't have fallen as much as they have, in my view. A lot of the US ones that fell, I'm as Amazon shareholder, they got smashed overnight. Apple fell because it's bringing products out of China, right, into the US. Amazon, I don't know how much of their product is sourced in China, for example, around the rest of the world. But if they do a lot of global sourcing, that means they've got to put their price up for American consumers. That probably hurts their sales. So there are reasons why some of those specific companies got hit. Should ours be hit as much? Probably not, I don't think. But again, company by company specifically. Nick, USA may go to, oh no, my screen's updated. Here we go. USA may probably go into recession. How will this affect the world economies in Australia? I think I've covered that as well, Nick. Hopefully, again, if I haven't, ask another question. If the US is the largest economy in the world's largest consumer economy by miles. We're a little protected because we're selling to China. If their infrastructure programs stay up, we should be okay for a bit. China's own economy may struggle if the US struggles. It's a pond. We're stone in the middle of the pond. The ripples come out. The US is the stone. We're not going to avoid impact. Hopefully, we avoid recession. Hopefully, they avoid recession. I don't want them to have a recession. Part of me wants a bit of quid pro quo for the tariffs, which is a stupid policy. I'm not sure the administration doesn't deserve a whack, and maybe that'd make me feel better at some level. But I'm not that way inclined. I don't want Americans to suffer. I don't want us to suffer. But if they do have a recession, we will get hurt. Our economy will grow less quickly. Whether that's a recession here or not, I desperately hope it's not. I kind of don't think it would be. I hope, but don't rule it out. Unfortunately, and that's kind of where we are. I don't mean to worry anyone, by the way. I think it's fine. It's not a big deal. In the long term, again, as I said before. All right. I'm having trouble with my screen here, but let's go. Gold has been booming, safe haven. Yeah, it has. Absolutely. That's been the concern. Why has gold boomed? Generally, people are worried about inflation or money printing or both. That's what's happening. Do I invest in gold? No. Why? Because I think over the long term, gold won't do as well as shares. Even if you believe inflation is going to keep happening, I think shares outpace inflation. If gold just keeps pace with inflation, it's not a bad hedge, store of value. I want growth in value, so I don't invest in gold, but to each their own. Quiz Queen Caroline, Australian Wagyu is the second best in the world. Only Japanese Wagyu is a better quality. I have no argument with you whatsoever. Australian beef is fantastic. I completely agree. Where do you see mining giants headed? Man, that's hard, AP. It depends on how badly China gets hit by US tariffs and what China does as a result. On one level, they might say, our manufacturing is taking a hit. We're going to do more infrastructure to keep the economy afloat. That could be good for us. It may be they say, well, everything's down in China. We're going to have to pull back a little bit. That's going to be bad for iron ore exports. Rio is hard for two reasons. One is, what do the tariffs do for those chains of demand? The other is what happens to price. The oil price, I saw this morning, fell 7% on the news. Why? Because people are betting that oil tends to track roughly with global GDP. And so if the oil price is down, people are betting, and they're only betting, could be entirely wrong. US economic growth or activity declines, world economic activity declines. In that circumstance, do commodity prices decline as well? Probably. So Brio's going to look at volume, but also price. I own shares in Fortescue, by the way, full disclosure. I don't know what happens in the short term. Again, I don't really care. Again, it sounds like I'm being AP. It sounds like I'm being kind of flippant or negligent. I'm investing in Fortescue for its long-term potential, not just what might happen over these tariffs. And again, here's the thing. Do I sell out because maybe they fall? I could. What if they don't fall and they rise and I've already sold out? Well, then I missed out on that opportunity. And if shares go up over time, I'm betting against the trajectory of time. And so you kind of like, that's where for me, selling out trying to avoid a dip is really dangerous, because maybe I get it right once or twice or three times. But over the life of my investing career, the dip I foresee doesn't happen. By the way, the market's already fallen. We're talking about this after a 5% fall in the US overnight, right? Maybe it keeps going, or maybe it doesn't. But over time, if the market goes up, the longer I'm out, the longer I'm waiting for an entry point back in, the more I'm running with sandbags on my feet, trying to make sure I stay in touch with the market as it's rising. It's the COVID example I gave before. So I know what happens to Rio. I suspect volumes come under pressure. I suspect price comes under pressure, but maybe it doesn't. And I'm not selling my Fortescue as a result, because I just don't know. Stephen, can you please address why it's okay for many countries to have sales tax and tariffs, not for the US? And if the US keeps increasing their trade deficits, what's going to happen then? Great question, mate. Really great question. Hopefully you've heard me say tariffs are bad, no matter who imposes them. Biden imposed them on China, Chinese cars. China imposed them on Australian wine and barley and seafood and God knows what, because I'll try and make a political point. It's bad, 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 bad. There is no good. It's only tariffs are bad. So don't. Now, sales tax is different. Sales tax is entirely different because it applies across the board, no matter the source of the product. In other words, we're not differentially treating. A tariff is a differential treatment based on source. A sales tax is a sales tax is a sales. New York has an 8% sales tax. We don't put a tariff on products coming from the US because New York has an 8% sales tax, because it applies to all their products equally. There is no process by which they discriminate on source. That's why tariffs are bad, because they undermine I've already told you this. You probably sent the question beforehand. They undermine the efficiency and the opportunity. By the way, why do we trade? Because we make really good wheat and lots of it, right? In Bangladesh, they make great shirts and lots of them. In New Zealand, they make great Sauvignon Blanc and lots of it. And so we say, we make some great Sauv Blanc too, by the way. Don't misunderstand me, especially the Tassies. We say, we'll see our wheat because it's cheap and good, and we make lots of it, and we do it really well. And the Bangladesh say, we'll send you some T-shirts because we have low wages and we make lots of T-shirts and we make it pretty well, and you'll benefit from that. So we're great. So you get our wheat, you get wheat, and you get cheaper wheat that you have to grow it there. Think about Japan. No reasonable farmland, no meaningful farmland. They buy our wheat, we buy their cars. Why? They make better cars, cheaper cars, better quality cars. Why would we not? And if you think about that in a broader sense, draw your circle around a small community. Think about how big it needs to be. Why national borders? I mean, there's sovereign issues, but why national borders? If I said, I live in Barrel in Southern Highlands, New South Wales. If we drew we put a big wall around the outside of our LGA, local government area, said, right, anything that comes in here gets tariffed. And everything, and the guys next to say, well, everything that comes from you gets tariffed. Like, well, we do some decent wine and we've got some good tourism and bits and pieces, but we don't have any shoemakers. And like, well, sorry, we'll buy your wine for the tariff, and you can buy our shoes for the tariff. We're like, well, why would we do that? You make good shoes and they're cheap. You make good wine and they're cheap. We'll swap and both be better off. Or we can both add tariffs and both be worse off. Makes no sense. So anyway, that's the answer, Stephen. What if the US increase trade and debt deficits? Man, that's a big question. And trade deficits and debt are very different things. They can be correlated depending on government policies. Absolutely true. Australia generally runs, it's been all over the place. I won't get into it. What happens? Oh God, so this is a long answer. The currency is impacted by the US trade deficits. It also increases their amount of debt because people have to use US dollars to pay the US for their products. The cost of the debt can be problematic, although the exchange rate tends to float, but also their reserve currency. So they're different from any other country with the same problem, because their reserve currency is the de facto, and by the way, they want it to be. That's why we buy oil in US dollars. They want it to be the case. So the kind of, you're not wrong to ask the question. So debt's different. Debt is just spend and tax. That's easy, right? That's not trade related. It doesn't need to be trade related at all. They can make it trade related if they choose to, but that's a furphy if they say we have to solve it this way. We don't. Australia should solve our own debt problems, not through trade measures. So debt is, to my view, irrelevant. You may disagree, and that's cool. Just giving you my. By the way, I'm not perfect. I'm giving you my considered view, but if anyone disagrees, you're welcome to. Doesn't mean I'm going to stop saying what I think, but I'm not pretending I know everything. I've got all the answers. The trade one is really hard, mate. If they want to fix it, they have to accept the lower standard of living to fix it. So they want to be really careful about that, how that plays out, is the short version. Some arcane economics, sounds like you know what you're talking about, which is great. It's probably over. We've got 10 minutes left. I probably won't go into it more, mate, but I get your point. Yeah, the BBOZ, it's the bear, has boomed. Yep, absolutely. It's going to happen. Banana Republic, says Nick. I don't think so, mate, but you never know. Tariffs neutralize subsidies, says Kevin. Yeah, I hate them both. Telegraph cucumber, $5.69. Jeez, all right. I won't buy cucumbers in New Zealand then. Coal future. Oh, man, that's a massive question. Completely unrelated. I have been reluctant to invest in coal companies, not actually for ethical reasons alone. I have got ethical investing, which again is for another day. But the question for coal companies is whether or if they are operating stranded assets. And so what you've got to try and guess, regardless of your view on climate change and climate change policy, it's not about what I think. It's about, do enough people think they want to stop coal mining to leave some of these businesses with stranded assets, either on regulation, ban, price, whatever, some sort of carbon tax, either locally or internationally. So it's just hard, right? What's left? If I had a coal miner who was raking in massive profits, selling cheaply, and we using that cash to invest in something else to diversify their business or actually get out of it. A great example is Philip Morris, the cigarette company in the US. By the way, was, I think, Quiz Queen's point about cigarette taxes. They saw it coming, so they invested some of their proceeds in food businesses, right, to try and basically diversify their business away. You can buy coal. I'm not against it. I'm against carbon in the atmosphere. I'm not against buying coal miners. Different things, in my opinion, reasons. I'll explain a different time. Yes, I don't know how many of those assets remain stranded, mate. So I've avoided it. I just think the risk of some portion of that value. If they mine up until the day they're shut down, and all that's left is a coal mine they can't sell and some chairs and tables, then your value, the end value of the shares is zero. Now, maybe something happens between now and then. I don't know. It's too hard basket for me. Thanks, Owen. I wish people, I shouldn't read this, a bit self-indulgent. I wish people with your clarity, logic, and deep analytical thinking are actually running this country. Be careful what you wish for, mate. But no, I wish we had less politics in politics, which sounds stupid, but better people in Parliament. Yes. Can I make a plea to everyone watching? Please exercise your vote carefully in May. I don't care who you vote for, as long as you do it thoughtfully and sensibly, and really interrogate the logic of the platforms. A lot of our minor parties and shouting heads are just shouting problems, not answers, not solutions. And a problem with a slogan is also not a solution. I'm not taking anyone in particular. All I'm saying is please have a think. Whether you're on the left, whether you're on the right, whether you're in the middle, please vote conscientiously and carefully. That's my plea to you. You're smart people. You're watching this. You care. You're an investor. You're interested in topics like this. Please exercise your vote really carefully. Don't just go team red, team blue, or team green, or team orange, or team whatever colors there are these days. Team teal. Please exercise your vote appropriately based on a really serious consideration of the issues and who's going to genuinely solve them, rather than just who's got great slogans for the problems themselves. One says, is a bully going after our lunch money? Yeah, you're right. What can we do? Nothing. We should do absolutely nothing about it. Why? Some of the hairy-chested, Tony Abbott shirt fronting Vladimir Putin. Well, you're right. We're not big enough. The school bully's taking our lunch, right? The less you say, no, you can't get the rest of my lunch money. Well, I will then. Thank you very much. Or you try to hit the bully back and he hits you back harder. You're not going to win. We don't win an arms race with the US financially. You just don't. Financial arms race, to be really clear. So we just cop it, sweet, and find other ways to do business. Not because it's great, because we can't stop it. And it's really disempowering for a lot of people. They just want to be able to say, well, we're Australia, we should do something. Sometimes you've got to be like, you know what? We don't win by fighting back. We really don't. You kind of go, okay, well, you're going to be a knucklehead about it. Fine. I'm going to make sure I've got relationships. So what do? We form other bilateral, multilateral trade relationships with other countries. We say, right, the US is doing its thing. Fine. We'll still sell as much there as we can. In the meantime, Let's find other places that we can actually sell our stuff to, and we'll sell us their stuff. And that makes us more prosperous as a community. Trade works. Trade is important. Let's go to those pro-trade countries and do more work business with them to make up for what we're losing. They're losing stuff as well, so they're looking for other markets. I hope our governments, plural, current and prospective, whether they are Labor or Liberal, have that conversation with other leaders. I hope they're happening right now. I hope our companies are looking to diversify their own businesses. We're just going to have to suck it up because there is no best, there is only least worst. Currently restructuring my portfolio away from shares, combination of shares and ETFs. Should I sell them already poor performing prior to today? No, don't sell anything or buy anything based on past performance, is my humble opinion. I can't tell you what you should do, Dean, as a general rule. Why? Because it doesn't matter what the share price has done between now and then. It matters what happens from here and moving forward. Plenty of companies have had poor performance and then go off to set really great new highs. Others have poor performance and keep going to lows. You can't tell from the past what the future is going to look like. Sell the ones, in my opinion, I can't give you personal advice, that you have least conviction about the brightness of their long-term futures. You've got 3 companies, you go look at them all and go, this one's got a great long-term future. This one I'm not sure about. That one, I think it might be okay, I'm not sure. Work on conviction first is my view. Obviously, price and value matter, but again, when I say the futures are relative to the price, they're the ones I'd be selling personally first. Is GST just another tariff? No, it's absolutely not. I just talked about that. A sales tax is a broad sales tax regardless of source. A tariff is absolutely taxed based on source, has massive economic implications. But yes, honestly, if we're going to introduce a 10% GST, another 10% GST or everything, not doing anything else, we'd have inflation here too. We'd have a recession here too if we did that. So on one hand, no, they're entirely different. On the other hand, if you add a tax to anything in large amounts suddenly, yeah, you're absolutely going to cause problems unless you offset them somewhere else. Hal, great time to top up super if you have the ready cash. I'll say yes. It may fall further. So I'm not saying buy because this is the bottom. I am saying if you like shares yesterday and they've fallen 2% today, unless something's changed about the business's future, you should like it a lot more. It's fallen a lot since this year's been a rough year for investors, last 6 weeks in particular, since the tariff talk started. If you like the long-term future, I'll say Woolies, so I don't own the shares, and it's not a recommendation of mine. If you like Woolies, if you liked them a week ago, if you liked them 4 weeks ago, and nothing else has changed about their business, let's be honest, and they're 10% cheaper, they may not be, whatever they are, then yeah, you should like them more now. Does it mean you should buy them? Maybe, not necessarily. There might be better ideas out there. They may have been really expensive a month ago and only just moderately expensive now, in which case don't buy them. So don't just buy, like I said previously, on the basis of what the share price has been doing. Buy or sell based on your view of the future. But yes, if you like the company already and it's 10% cheaper, it tells you everything you need to know. Thanks everyone for being involved. I'm going to really try hard. Gary says you are the financial expert that Trump pretends to be. Thanks, I think. I'm not sure. But if that is a compliment, thank you, Gary. If it's a slight or on me or Trump, then I don't know. Maybe he should be more offended than me. I'm not entirely sure. MCAT. Yeah. Oh, man, super. I was going to talk about that. We've run out of time. So there has been a hack on some super funds for their members who are in pension phase. I don't want to panic anybody. It's been done. They've taken the systems offline. They're resolving it. I don't know what the fallout will be yet. We're doing this live. If you are in pension phase with an industry super fund or one of the largest retail funds, Google the story. Actually, there's more detail. I'm not going to try and do it now. Not do it justice. It's really important to be accurate and correct. So I'm not going to try and summarize it other than to say, apparently it's only in pension phase accounts is what I've read this morning. It's only some industry funds. It's one big retail fund provider. SMH's got a story. I'm sure all the papers do. Jump online, find out what's going on. Your super fund will be in touch. Check their website if you need more details. 500 watching, great work, Scott. Thanks, Al. Oh, Hal says, please all hit the like button so more people can hear common sense from Scott. I'm not going to disagree with that. I'm going to hit the like button right now on my screen. Does that work if I do it? Yeah, it does. I can like my own stuff. Please do, if you wouldn't mind. If you're enjoying it, if you want other people to see it and find it, I'd appreciate it. You don't lose anything by having more people watch. So if you do like it and you're enjoying it, please do. Please subscribe to the channel. Please hit the notification bell. Remember, 4:30 this afternoon, stock of the month coming out. Whew, how am I going? I'm running out of time and I'm not even... No, I'm getting close to the end, actually. All right, here we go. If I was going to invest in the US stock exchange, should we wait until there's another US-based recession? Same problem, Caroline. Let's say there's a US recession, the shares fall 10% when it happens. But let's say they go up 15% between now and then. You're still buying at 5% more than you could have bought them today. Now, maybe they don't. Maybe it goes straight down from here. I don't know. It's all market timing. It can't be done reliably, in my humble opinion. Dollar cost averaging, invest regularly every time you got some money saved up. Take some money from your pay, put it in your investment account, invest the money, buy some shares. It's how I do it. It's how I recommend people do it. But trying to time the market is impossible in my view, or all but impossible. What does dollar cost averaging do? It means when the shares are high, you buy fewer shares with your dollar. When they're low, you buy more shares with your dollar. So you're actually kind of taking advantage of those, you're not timing the market, but the weight of purchase is greater when the share prices are low. So I would dollar cost average. Personally, I can't tell you what you should do. Jake, Adore Beauty, man. I don't love the new store concept necessarily, but I'm happy for them to have a go at it. Maybe it helps. We're seeing physical beauty stores do really well. Adore Beauty, for those who don't know, I own shares, was an online only beauty retailer. Worth a go. I would try it. Do I think it's going to be massive? Not, I don't know. Am I putting any value in it, storing it? No. Am I taking any value away from it? No. All companies should be taking calculated risks. I have absolutely zero problem with a risk. If it fails, that's okay. They tried. It was smartly designed. They did their best. Didn't work. Cool. Now they know they can move on. If it works, even better. Global and healthcare, healthcare stocks. Healthcare is hard, Gavin, because healthcare is kind of everything. I'm going to go a little bit over time here, guys. If you've got the time, stick with me. I'm going to try and answer as many questions as I can get to. So probably another 5 minutes. I've got something to do a bit later. I've got a radio interview to do. So they don't want me to talk to you while I do that, although it'd be fun to do online, wouldn't it? Healthcare is so hard because healthcare, it's this massive thing that incorporates health insurance, hospitals, diagnostic companies. People include aged care in it. Aged care, by the way, is largely just a property trust with a very specific clientele, really, honestly. I don't mean that disparagingly. It's just the property is far more of the value than the operating business, generally speaking. So healthcare is hard. What do I think? I haven't seen a lot of attractive healthcare companies. They might be somewhere that's less volatile because they're local and they're doing their thing and there's no trade and stuff. I can see people looking at them. I haven't seen a lot of value in them and I haven't seen a lot of growth in them. So I can't tell you I love them. I can't tell you I hate them either. There's none I'm short or it's nothing I particularly hate. Just be careful trying to find safety in stuff that might be overvalued or not growing. Wise Woodside, actually, hang on, Breville. Is it worth keep the shares that are affected a lot by tariffs like Breville? Here's the problem, Shirley. A lot of those shares are already going to have reflected the impact of the tariffs. So you kind of, like everything, if we had inside information, we couldn't use it because we go to jail. But if we knew something before everyone else, we could maybe trade some of that stuff. Once it's known, the question really is, do we think the share price fall reasonably approximates the cost to the business of the lost profit? And what does that mean? Breville operates in the US. I don't know how much. I imagine most of their products are made in China, I would suspect. So maybe it's a big deal. I haven't seen the share price response, so I can't give you a good answer. Don't worry about the fall that's happened. Think about where it's positioned now and its future value. Brendan's taking a lot of questions away. I hope I didn't offend you, Brendan. You haven't gone somewhere else. Kevin asked, why is Woodside being hit so hard? Because the oil price was down 7%. I mentioned that. Why is the US dollar not dropped? We expect to drop a lot based on this. Kind of comes down to trade flows a little bit. There are people who are buying and selling US dollars. It gets a little bit complicated. Largely, also got capital flows, people taking their money back. Whenever there's a crisis, the US dollar rises, and it's largely because people in the US say, "Oh, money back here. I don't want to take any of those international risks." I don't know what will happen from here, but that's probably in the short term why it's happening. Others are betting on the trade flows as a result. And if there's less demand for if there's more demand for US dollars, you'll see more, and less demand for international currency because they're buying more imports. The US dollar should rise on balance. Again, theoretically, mathematically, sentiment is a whole different thing. Andy, endpoint moving super funds between categories. Only if you could time the market, Andy, and I can't. I've said that a couple of times. I don't mean to be flippant about it. I haven't. My money is all in shares. It's all in shares for the long term. I have a long time horizon. I've got hopefully a couple of decades to retirement, and hopefully another 2 or 3 decades after that. Now, if I live to be 100, I've got 50 years-ish. So, we're gonna have 4 or 5 or 6 recessions over that period of time. We're gonna have more knucklehead political leaders doing stupid stuff here, there, everywhere else. Do I think that would I move out of shares rather than harness the value of that ingenuity and growth and development and all that stuff, value creation? No, personally, no. And again, if we're doing the Monday morning quarterback stuff, the game's already been played. It's too late to make some changes. You can if you want, if you feel better about it. Sleep at night test is really important. Again, I can't tell you should do, Andy. For me, there's no need to change. Roughly half of my portfolios in the US, roughly half is here. No surprise the US portfolios get hit harder. I'm not changing anything. I thought it was a long-term issue, a long-term implication on these companies. I might, on a company-by-company basis, if it was just less attractive as valuation-wise. But no, I haven't changed anything yet. I don't intend to. Almost the end. All right, thanks for sticking with me a few minutes. Steve, thoughts? This is really just to refinance US debt. Yeah, it could be, mate. It's an expensive way to do it, though, right? You mess with the US consumer, and you mess with almost off my radio. You mess with the US consumer, you mess with trade, you mess with trade alliances, you mess with geopolitical alliances. So it's possible, yeah. And that's been advanced as a reason. The question, I don't want to get political, but it's very hard for me to have a sense that Donald Trump is a deep policy thinker who is genuinely trying to do this to repay the US debt. I don't have any sense that was his aim during the last term. In fact, he made the debt worse by borrowing a lot of money. Has he suddenly seen the light? Is there some Damascene conversion? I mean, it's a very generous view, yes. And if it was true, then hey, it's a way of doing it. Would I do it to punish US consumers, particularly the voters he presumes to stand for, so they can repay the debt? I don't know. Again, is it possible? Yes. So I don't know Trump's mind. I'm not inside those rooms, and I have to allow the possibility. It doesn't strike me as likely, given what we know of what he's said and done in past terms and his public announcements in general. But it's possible, I suppose. Yeah. Okay. Help me says, good evening from the USA. I think I've been pretty kind about Americans in general. Help me. I haven't given you a bum steer. I love American people. They are wonderful, wonderful people. We're actually owned by an American company, actually. The Motley is a US business, and it wholly owns the Australian business. So, hello to my American colleagues and friends. My aunt is also an American citizen with her husband. So, big fan of Americans, not a big fan of what the current administration is doing. And it's always important we separate those things out, right? Whenever you talk about a country, we really should talk about the country's government versus the country's citizens. So, help me. Thank you for saying g'day. Thanks for joining in, by the way. CL, thank you. Such a beginner. I learned so much. Thank you for that. Brendan, if the market had a 13x gain over 30 years, is the reason to avoid timing the market? Doesn't the same logic apply to try to pick individual stocks or ETFs? Yeah, potentially. Here's the how much time have I got? I've probably got. If the phone rings, bear with me. Okay, I've talked about the paradox of investing before. You can Google that. Actually, Google it and go to my Twitter account. The paradox of investing. As a group, none of us beat the market because the market is the market. So as a group, we should all buy ETFs. However, should Warren Buffett have avoided trying to pick stocks? Well, I don't think so. So it's the paradox, mate. Everyone should index, but those who can beat the market should. How is that? Can they both be true? It's Schrodinger's cat. We're both dead and alive at the same time, right? So, yeah, that's my answer. People are able to beat the market by clever stock selection, it seems, in a small number of cases. I've thus far beaten the market at Motley for Share Advisor for 14 years in total. I'm pretty happy with that. Do I think it can go on forever? I hope so, but I can't promise you. So yeah, I don't blame you for having that view. And if that's your view, I think that's absolutely appropriate and absolutely reasonable. Why is corporate travel getting hammered? I don't know specifically. I haven't seen that share price down. I own the shares, as you know. I can't imagine why, honestly. I don't know. I imagine it's probably businesses with links to the US are getting smashed because they're getting smashed. I don't know factually why they should be. They're a service provider. They don't send products. I haven't seen any tariffs on services or cash flows. So I'm more likely to be a buyer than a seller over the 10% reduction, but I can't tell you what you should do, Terry, and I can't tell you what else they should do. Still a buy for us. Thank you for sharing your knowledge and experience. Thanks, Gary. Very kind. Any future for Star? Yes, but probably at very, 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 very reduced rates for shareholders. Meaningful value reduction, if anything at all. There's also a very real possibility it goes to zero and gets reborn as a separate entity, and the shareholders get nothing. Mick, thanks for Moat. Scott, owns 60 direct it way back on Share Advisor. Thank you. 60% cash at the moment, looking to add stocks at times like this. I can't tell you what you should do, Mick, but I reckon that's probably a good idea. Okay, I'm going to sign off before the phone rings and embarrasses me and all of us. Thank you very much for being with me. If you want more of these, please let us know. Please like and subscribe. Not for my sake, well, good for the ego. If you want more stuff like this, if you want to know when it's coming up, stock of the month coming out this afternoon, what I've been reading out tomorrow morning. Thanks, Phillips. Have a great afternoon. Have a great weekend. Stay the course. Stay the course. Aesop was right. In the end, the tortoise wins. Thanks for watching. Have a great day. Have a great weekend. And full on.